Okay, so in this video, I want to go through a particular issue that applies to fixed assets when calculating deferred tax. In the question Kane Limited, I didn't calculate the value for fixed assets because I hadn't covered this particular material. So this is something that is specific to fixed assets. It's a slightly unusual thing as well. It may be almost unique to Ireland. Certainly in the UK, this wouldn't be an issue. So we're looking at fixed asset adjustments. Now, the problem that gives rise to this issue is that certain fixed assets that you buy don't qualify for capital allowances, okay, or don't fully qualify for capital allowances. The classic example, excuse me, is expensive cars. So cars costing more than 24,000 at the maximum will be restricted for capital allowance purposes to that value, and the allowed value can be much lower. Okay, it can be 12,000 in some instances and zero in the case of gas guzzling vehicles. Also, for industrial buildings, you may recall that you don't get the full cost. For instance, site cost is restricted when calculating the value of capital allowance qualifying costs for industrial buildings. Now, the big point is that this is a permanent difference. Okay, so if you think of a car that you buy for, say, 30,000 euros and it's only going to get capital allowances of 24,000, on day one you have a permanent difference between your accounting book value, which is 30,000, and the corresponding tax written down value, which is 24,000. So you have a permanent difference, and we cannot allow permanent differences to give rise to deferred tax. So we have to do an adjustment to allow for these permanent differences. So the additional problem is that as you depreciate a car, the permanent difference actually declines. It itself is depreciated. So the adjustment wouldn't be a simple matter of, say, deducting for a car costing 30,000, deducting 6,000 off the accounting book value each year, because you've essentially depreciated the 6,000 each year as well. So we have to reevaluate the value to deduct. And I'm going to look at an example on Excel, but here's a scenario. We're taking a car that costs us 35,000, depreciating at 20% per annum straight line, and we're just assuming that you're allowed a qualifying cost for tax purposes, a tax-based value of 24,000. So in the next video, I'm switching over to Excel, and I just want to demonstrate the issue, and then I'll be returning to this presentation. Okay, so I've got the scenario for a car that cost 35,000 euros. Okay, so you can see here's the cost on day zero, the day we bought it, 35,000 euros, and we're going to depreciate it at 20% per annum. So in year one, 20% coming off 7,000 leaves a net book value or a carrying value of 28,000. Now, that cost of 35,000 is essentially split between a qualifying cost of 24 and a permanent difference of 11. So maybe just highlight those two terms. We've got a qualifying cost element of 24,000 and a non-qualifying cost or a permanent difference of 11. And after 1 year's depreciation, 20%, you can see that the adjusted or the net book value is coming in as 19,200, and the net book value there for the non-qualifying element is 8,800. That's your 28,000 in total. So when we are doing a deferred tax calculation, remember that we couldn't compare 28,000 against the tax written down value of the vehicle, because the 28,000 is essentially consisting of two bits. 19,200 is comparable, but the 8,800 is not. So we have to ensure that we do an adjustment to the 28,000. Essentially, we need to take off the permanent difference element, which in this instance is 8,800. So we'd end up comparing a carrying value of 19,200 against a tax written down value of some other amount. The tax written down value would actually be 24,000 euros minus 12.5%, which is 24,000 minus 3, which is 21,000. Okay, so in later years, again, I'm just showing the outcomes that the permanent difference amount in later years declines. Okay, so the permanent difference was 8,800 at the end of year one. It goes down to 6,600, so on and so forth in later years. And really, we just need to realise that these accounting book values have to be modified. They have to be essentially reduced for the permanent difference in order that we have valid comparisons between a carrying value and a tax-based value. Okay, so I'll email this Excel sheet in the email that I sent out alerting you to this video. Okay, so back to the PowerPoint slides, and I just skipped one slide, and I'm looking at how we calculate the adjustment that is needed when determining the comparable carrying value. So the permanent difference is computed as follows. We take the original permanent difference, which in our example was 11,000, and we multiply it by the accounting book value of the original purchase price. And that will give us the adjusted permanent difference. Okay, so we saw that the adjusted permanent difference on the Excel sheet was 8,800 in year one. And that would be the value that is calculated if we took the original permanent difference multiplied by the accounting book value of the original purchase price. So 11,000 multiplied by 28 over 35. 28,000 was the accounting book value at the end of year one. Original purchase price was 35,000. And we would then deduct that calculated value from our carrying value before entering those adjusted values into the balance sheet, okay, when calculating deferred tax. Okay, so I've got the solution to Kane Limited, which you saw demonstrated in the previous videos, and as I noted, I didn't enter a value for non-current assets at the time that I was doing the solution because of the issue of permanent difference adjustments. So I want to look at this point now. So I'm just going to switch over to the question. So the non-current assets had note 1, 860,000 was the total value of non-current assets, and you're told that tax and net book value details of non-current assets are as follows. So the accounting book value, the carrying value, 560 for land and buildings, 210 for plant and machinery, 90 for motor vehicles, and you can see tax written down values there. And here's the important statement. The motor vehicles include passenger cars which had originally cost 50,000 euros. Accounting book value is now 30,000 for those cars, but which had the sum of 21,000 disallowed for capital allowance purposes when they were first purchased. Okay, so the cars were granted a tax base of 29,000 when they were first purchased, but they actually cost 50,000. So there was a permanent difference on day zero of 21,000. Now, over time, those cars have been depreciated. So as you saw in the previous Excel demonstration, the permanent difference has also been depreciated, and we need to determine the adjustment to make. And I'm going to apply the method that was shown on the PowerPoint slides. So the original permanent difference was 21,000, and the accounting book value is now 30,000, and they originally cost 50,000. So switching back to the solution, and we go to the working for this. Okay, so note 1, our working one, tangible fixed assets. So we've got our categories of tangible fixed assets, and the accounting book values are just taken as granted in the question. So 560, 210 and 90, so ABV, accounting book value. No adjustment needed for land and buildings or plant and machinery. Sometimes in questions there is an adjustment for land and buildings because of the potential for industrial buildings restrictions. Now for the motor vehicles, okay, there is an adjustment, and that is calculated as shown here. So the original permanent difference was 21,000 multiplied by the accounting book value is now 30,000 over the original cost 50. So we take 12,600 off the carrying value, and that gives an adjusted carrying value of 77,400. These other assets weren't altered. So my adjusted carrying value is the 847,400, and that's the number that I'm going to insert in my solution to compare against the tax written down value for these tangible fixed assets. So 847,400, and again the issue there was the motor vehicles had an adjustment required. So going back to the solution, 847,400, and the tax base value is the sum of the tax written down values they were given in the question in note 1, 800,000. So we have all the elements now filled in. We can get our totals for each column. 882 for accounting book value, 802, 300 for the tax base value. So total difference is 79,700, one minus the other. And the value at 12.5% is 9963. So that value represents the desired closing balance on the deferred tax provision at the end of this year. Okay, and in a later video, I'll go through the accounting for corporate tax and deferred tax. That's the subject of a later video.